What is going on, guys? What is going on? Let me know if you can hear me. Let me just post a couple of updates. Make sure that I'm blasting, that I'm going live on the socials. So 1 second. Let me just tweet this out. Live now. Come join us for the FOMC rate hike decision. All right. What is going on, guys? Can you guys see me? Can you guys hear me? Let me know. Let me know. And then I will say what's up to you guys. But let me just send this out. Share. Whoop, whoop. And I will be sure to say what's up to you guys. 1 second. Tweet. Oh, shit. Too noisy.
Welcome back.
What is going on, guys? Hope you guys are doing well. All right. Let's see who's in the house. Soner, always good to see you. Richard, always good to see you. Lalo, always good to see you. What's going on, guys? A lot of the regulars. Eloy, what's going on, man? Haven't talked to you in a while. Proud and Real. Mohamed, play guitar. Do I play guitar? No, I just have a guitar for fun. I don't play it at all. Yes, of course I play guitar. Calls or puts? Neither. Z, hide the bazooka behind you. That thing? Kenan, that's a green screen, man. It's just a rolled up green screen, but I could see why you'd say that. Nabil, what's going on? Jonathan, Bishal, Paul, Joshua, Tao, Lionsden, Lewis, what's going on, man? All right. So obviously we are all here for the FOMC rate hike decision. We are going to get into that. Shafi, what's going on, man? Noor, Martin, sorry, what's going on from Netherlands? Zul Bakar, greetings from Dubai. What's going on, man? So yeah, obviously we are waiting for the Fed rate hike. Let's take a look at what's expected right now. 86% expected that we will do a 25 basis point rate hike. So naturally that means if we do as expected, the market will likely have, and by the way, if you guys are on here, hit that thumbs up. There's already like 700 of you on here. And there's only 62 thumbs up. We need to get 700 thumbs up. All right. Make sure that people are actually finding this quality content as opposed to going elsewhere for lesser quality content. Hit that thumbs up. So what's expected is a 25 basis point rate hike, 86%, and no rate hike priced in at 13%, and 0% chance that we get a 50 basis point rate hike. Remember, the ECB, the European Central Bank, did a 50 basis point rate hike when 25 was expected. Now, the reason that, you know, we did have an expectation of a 50 basis point rate hike last month, there was almost a 24% chance that we do a 50 basis point rate hike. But obviously, in the wave of the banking crisis, as you see here, you know, expectations have changed because now banks are crashing left and right. And the Fed actually opened up the tap once again to easy money with what they're calling their bank term funding program. And, you know, the market is saying there's no way that the Fed is going to raise 50 basis points with the fact that there's no way that the Fed's going to raise 50 basis points with the fact that banks are crashing left and right, because that is going to put added pressure on the economy. Now, there is a contrarian viewpoint that could oppose this, right? So if the Fed opened up the tap on easy money and basically are providing unlimited money in the form of loans this time to banks, either way, you know, the money is making it to the banking system and the money is making it on the Fed's balance sheet, which we'll talk about in a second. But if that's the case, then, you know, the Fed might say, and I'm not saying that this is the overwhelming consensus, But the Fed might say, hey, we opened up this bank lending program. There's no fear that banks are going to crash because we're going to backstop them by any means necessary. So, we're just going to do a 50 basis point rate hike and focus on bringing down inflation. That could happen. I think it's a lesser likelihood, but that could happen, in which case I think you will actually see the markets take a dive, obviously, if the Fed does a 50 basis point rate hike. Now, what I'm focused on more, because I do think that the stock market is a little bit separated from reality. What I'm focusing more is the Treasury market, right? I want to see here if the two-year Treasury tanks or rockets after today. Now, the two-year Treasury is the one that is the most tied to the Fed funds rate, not the 10-year like everybody thinks. The long end of the curve, the Fed actually does little to affect that in the short term. But the Fed funds rate is tied mostly to the two-year Treasury. And you can see here on the Fed site, on the Fed economic data site, that the two-year Treasury moves very much in line with what the Fed funds rate is. And once we see a pause in the Fed funds rate, in this case, the blue line here, then you see the two-year Treasury yield tank, in which case the two-year Treasury note will soar. And if we take a look at this weekly chart on the two-year Treasury, you'll see that this is actually the play, right? Here's what happened when the Fed paused during the 2008 recession. You could see that the two-year Treasury just rocketed as the yield plunged. We have now hit the same bottom on the two-year Treasury as the yields have soared. So we've hit the 2007 bottom, and we are at this level here. And if the Fed pauses or gives an indication that they're going to pause, then you can expect the two-year Treasury to continue rocketing, over the next year or two. So to me, this is the play here, not really the stock market, especially because I posted this in the Discord. But if you take a look at the majority of the declines in bear markets happen after the Fed pivots, right? And this is because the Fed doesn't pivot until the shit hits the fan. Now, in this case, are we talking about a pause or pivot? On this chart, we are looking at a pivot. And pivot means that the Fed actually starts the rate cuts, right? Meaning that they pause and then they cut. When they cut, it's usually because shit hits the fan. And I also posted a weekly analysis. By the way, if you guys want access to all of my analysis, all of the trades, everything, check out the link in the description. Click the link below. Make an appointment with one of our ambassadors. And if you are approved, if you apply and you're approved, you will know shortly thereafter. But I just put this very detailed analysis out this morning. But if you take a look at the futures, at the Fed funds futures, right now, we're not even pricing in that the Fed funds rate ends up at over 5%. And remember, this was near 6% before the banking crisis. So what the Fed funds futures is now pricing in is that we hit a high of 4.95% by June, and then we cut in August. We cut by around 25 basis points in August. That's what we're pricing in now because of the banking crisis. So where do I think the market is going to go? I also posted my long-term analysis on the S&P 500. But after the first Fed meeting, the February 1st Fed meeting, you could see here on February 1st, we popped above this inverse head and shoulders. But because of the fact that CPIs came in revised higher 4 out of the last 5 months, because the last inflation report for February looked like there were sectors of inflation that were really stubborn and were not going to go down. And because of the banking crisis, we have fallen back into the inverse head and shoulders and failed it. And this is where we are now, awaiting this FOMC meeting. So if the Fed does 50, I think we tank. If the Fed does 25, might be a muted reaction. And because of the unlimited money supply that they've now offered to the banks in the form of loans, albeit it's still liquidity being provided to the economy, I do think that the market can continue rallying until at least the next data set, which looks to be, let's see, when is the next CPI? Is going to be April 12th, 2023. So until at least the next CPI, we can continue rallying on the S&P 500 to around that, 4,200, 4,300 level. If the Fed actually indicates that we are going to pause today, I don't think that we're going to pause today, but I'm saying if they indicate, if Jerome Powell comes in and during his statement, he indicates that we are going to pause after this Fed rate hike, then I do think, and by the way, the Fed rate hike decision will be out in 19 minutes. So stick around. If you're on the stream, stick around, hit that thumbs up. Will be out in 19 minutes, and his testimony will be out at 2:30. His speech will be out at 2:30 p.m. Eastern time. So almost 49 minutes from now, and we will be covering it live. But the decision will be out in 19 minutes. So we will have the written decision out in 19 minutes, and then Jerome Powell's actual speech. But I don't think the Fed's going to pause today. I do think they'll do 25. 50 would be awesome. Not awesome in terms of, I'm not rooting for, the economy to crack under the pressure of the Fed rate hikes, but awesome in terms of letting the public know that we are not going to blink ever again. And we are going to fight inflation no matter what, regardless of what the market is doing. And as I said before, it would really be a contrarian move, especially since they opened up the tap of easy money and said, hey, banks, don't worry about it. Any bank that's, under threat of failing, we got you covered. So, as long as they got the banks covered, in my view, I think they could do 50 here. I really do. Now, what a lot of advanced economists are afraid of, they're not afraid of banks anymore, right? The banks crashing is not a thing, especially with this bank term funding program. It's just not a thing. It's clear that the Fed's going to print as much money as possible in order to backstop the banks, even though they're calling it loans. It doesn't matter. They're providing liquidity to the market, and they're willing to put as much money on their balance sheet as necessary. It took them 11 months to take out $600 billion off of their balance sheet, and just a week to add $300 billion back. So they're not serious about this aspect of providing liquidity to the markets. But as long as they got the banks covered, in my view, I think they could do 50 basis points here. But what advanced economists are worried about is a credit event, and the banks crashing is not enough of a credit event. But we're seeing consumer credit levels at all-time highs. More worrying, we are seeing corporate credit levels at all-time highs, right? So under that type of pressure, where interest rates continue to rise rapidly, with these credit levels at all-time highs, something will crack. And economists think that is going to be in an area of the economy that is likely tied to either consumer credit or corporate credit or both, not what is going on with the banks now, okay? So hopefully that is clear. Let me see if you guys have any questions. Johnny Curry, appreciate your donation, my brother. Thank you for always donating, man. Thank you for always watching. Thank you for always donating. John, what's up, brother? Thank you so much for donating $20 to St. Jude's as well. Appreciate you guys. If you guys have any questions, both Johnny or John, let me know. John, thank you for the comment. Z, keep killing it. Appreciate you, man. If you guys have any questions, for those of you that donate to St. Jude, you will definitely get a priority answer. But thank you. All right, let's see. The problem is the banks and the corporations who do not invest the money into the people. I'm watching the age of easy money. Yes, I shouted that out in my last YouTube video. But watch The Age of Easy Money. It's a free documentary by PBS. It's one of the best documentaries I've ever seen on what happened after 2008 and why we are still seeing the same thing happen now, and why the market is addicted to easy money. And I've gotten some comments from some of you who say, hey, it's not available on YouTube. It is available on YouTube. It's here. But what's likely happening, it's this Age of Easy Money full documentary Frontline right here. But some of you that are in Canada or maybe other locales might not find it, in which case I say use a VPN. change your VPN to a location in the US and watch it. It's amazing. What's up with that 50? I need that. What 50? Christopher, what are you talking about? Anonymous donated $20 to St. Jude. Appreciate you. Emedi Conet or Emedi Kone or Emedi Sone. Sorry if I mispronounced your name. 20 pounds to St. Jude's. Appreciate you. Thank you so much, guys. Steve B, I just watched it last night. Amazing, wasn't it? Yeah, it's almost 2-hour documentary, but it's done by an investigative finance journalist. And basically, the crux of it is that after 2008, the market has been addicted to the Fed and whether or not the Fed provides easy money. And before 2008, that wasn't the case. But after 2008, the market moves in line with the Fed. Are interest rates near zero? Yes, the market loves that. Is the Fed providing unlimited liquidity to the banks? Yes, the market loves that. When the Fed tapers or when they threaten to taper or threaten to raise the rates, the market tanks and they throw a tantrum. And that's been the case since 2008, right? And so, you know, another highlight of that documentary is showcasing that the Fed cannot actually force banks to use the money that they give the banks for what the Fed is intending that money to do, and that has to come from legislation, that has to come from laws. So you can't just give money to the banks and then expect them, you know, with no parameters, no legal parameters imposed on them, and then expect them to do the right thing. And so that to me is where the missing piece is that I think that there should be executive decisions made. If the Fed is going to provide liquidity to the banking system, there should be executive decisions made, or somehow, some way of implementing a really fast-track piece of legislation that tells the banks, hey, you have access to this money only if you use it for this. Instead, the banks go out and, you know, speculate further, or use that money for, you know, for their own benefit, as opposed to using it to really, you know, backstop certain holes in the economy, right? All right. Let's see. Oh, and by the way, the Fed's balance sheet, we're going to the Fed now every week releases an update on its balance sheet. And we get that Thursday afternoon at 4:30 p.m. Eastern time. So we will see tomorrow on the Fed's next update how far this balance sheet has pumped. This was as of last week. We added $300 billion in a week. I'd be very curious to see what happens tomorrow, right? So Shafiq, thank you so much for your donation. Hans, thank you always for watching, commenting, and donating as well. Thank you. This must be the track. Age of Easy Money, solid. Thank you for the tip. Yeah, hope the dude is still narrating Frontline documentaries. Yeah. The narration of the documentary is amazing. What's the story with St. Jude's? Love the gesture. No story besides it's to me a you know an honorable institution to give money to if you're going to give money. I just, you know, was when I would do these live streams, Annie, thank you so much for your donation. Appreciate you, man. When I would do these live streams, you know, people would send me super chats all the time trying to get me to answer their questions. And I just saw that YouTube, they had emailed me at the time saying, hey, we have a new program that allows you to do fundraisers on your live stream. So, you know, I thought I don't need the money from the super chats and whatnot. I appreciate the gestures, obviously, but if we can replace the super chats with the donate, you know, why not? Why not talk about the markets and talk, you know, we're obviously all trying to make money with the markets, but not to lose sight of you know, trying to do something altruistic as well. We could talk about the markets. We could try to make money. We could talk about, you know, trades and whatnot. while still providing value to an honorable institution like St. Jude's. That was it, really. I just got an email and decided to do that. And so since 2021, all of our live streams have been St. Jude's fundraisers. So yeah. Omar, thank you so much for your $20 donation. Wow, you guys are donating like crazy today. Pokemania, thank you so much for your £5 donation. Appreciate you. How much do you donate from your profit to charity? All of this goes to charity. I don't collect a profit from these live streams. Yeah, all of it goes to charity. And it's not like I take the money or handle the money and then give it to St. Jude's. It's a third party that YouTube has contracted to collect these donations and give them to the cause of your choice. And so there are these charities that you can pick from the list, these approved charities that you can pick from the list, and they handle the money. So I don't see any of it. It actually goes directly to them. You can read more about it if you Google it. YouTube fundraiser, YouTube fundraisers, and you can read about the mechanism. But I don't take the money and then donate it. It actually goes directly to them. I don't see it at all. So hopefully that answers your question. Plant or Benavidez this weekend? I think that is a good fight. I don't know. I think Robert Plant is his name Robert Plant? It's Robert Plant, right? I think he had a good showing against Canelo, even though he lost. Maybe Plant. Those third party are scammers. You have no idea what the fuck you're talking about, Trouble Man. We're talking about Caleb Plant. Robert Plant's a musician. Yeah. Trouble Man, you're just spreading rumors. You have no idea what the fuck you're talking about. Honestly, this is just unfounded conspiracies, and I don't appreciate it. Yeah, Robert Plant is from Grateful Dead, right? Jimmy Page and Robert Plant. Led Zeppelin. Fuck, I'm all over the place today. Do you declare it in tax returns for contributions? What are all these questions? Why the fuck do you guys care? Either donate or don't. Like, Jesus Christ. No, I don't declare it in tax. If I donate myself, like if I take money that's in my bank and donate, which I don't need to disclose to you, and I don't care to disclose to you because I'm not trying to impress nobody. But yes, if you donate from your bank account, then yes, you declare it in charity. You declare it on your taxes as a charitable contribution. In this case, I don't touch this money. It's not my money. It's your guys' money that's going straight to St. Jude. So no, I don't declare this in my tax returns because it's not my money. So Jesus Christ. All right. Why do you read the stupid comments and get mad that you read them? Good point. Random name. I don't have a good answer for that. Any market questions? Yes, please. Market questions. GC, you remember Jason DeGarmo? That was so funny last week. How to play this event, Straddle? No, I sent out, in my analysis this morning. By the way, there's 1,700 of you and 393 likes. Hit that thumbs up. Let other people find this. Make sure, don't let friends go to lower quality streams. Make sure that you guys hit the thumbs up. That's how more people find this. That is how more people get quality information about what is going on. Fed rate hike decision, 6 minutes. 6 minutes. 6 minutes. 6 minutes, doggy dog, you own. Z, get a cutting board. I do have a cutting board. Jesus Christ, Josh. Marry me, mother effer, Raul. Bro, come on, man. Stop it, bro. Stop it. 2K, this is the largest audience? Is this the largest audience? Like ever? Nah, bro. But hit that thumbs up. 546, not enough. Get it to 2,000. Get it to 2,000 and I will do a giveaway. I will pick a random person. You don't know what I'm going to be giving away. I will do a big giveaway if you get this to 2,000 likes. I'll pick one of you at random today. I promise you. Jay Musser donated $5. Appreciate you, Jay. Thank you so much. All right, let's get back to the freaking markets. All right, let's see what the S&P is doing. There was a sweet trade on NQ this morning. Really clean price delivery. ES is delivering. I mean, NQ, the Nasdaq, is delivering a really clean price this morning ahead of the FOMC. We had this bread and butter trade, a retracement back into after the market structure break, a retracement back into the imbalance here, taking it long, making new highs, taking liquidity again, coming back down to VWAP, or you can even look at it back down to this consolidation level that we see here. This is just really clean price delivery that you don't normally see pre-FOMC. Normally, this thing's going haywire, insane, like off the charts, right? ES, a little bit harder to trade this morning because it has taken the opposite route. And instead of going up, it has really, it's gone up, came back down. And instead of retracing off of this imbalance that you see here, right? It has just blown through it like a hot knife through butter. Now we tanked well below VWAP and are coming back up. So S&P much more volatile, which I think if you look at the VIX, you probably will see that the VIX is slightly up. Oh, I'm wrong. VIX actually tanking today. VIX is down 2%, threatening to drop below 20, but hasn't got there yet. It's impossible to do TA on the VIX, so I'm not even going to do TA on the VIX. Just looking to see that the VIX has actually dropped today. So, all eyes on the S&P 500, really. The NASDAQ, to me, is delivering actually really clean price. If you are going to trade today, I would say, probably NASDAQ, as of now, is a much cleaner trade. But, someone had asked me if I was doing a straddle or strangle earlier. I posted this in my detailed stock market analysis of what I would do today, and a strangle or straddle is not one of them because they are actually very high price. The premium is too high. You are going to see IV crush. And, a large move is being priced in on a straddle or a strangle. If we take a look at this, and we take a look at the SPY at the moment, you could see that if I pull this in here, you could see that we are expecting, a plus minus $8 move on the SPY by Friday. So if the SPY doesn't actually make that move, all of your strangles and straddles will lose money and will tank. So that is why I'm not a huge fan today of a straddle or a strangle, because a large move is priced in, and there's just a lot of speculation going on with the fact that this might be the last Fed rate hike for the year, right? I'm really looking to play, and I sent this out as well. I sent out my trade for the 2-year note futures. And again, if you guys want access to all of my trades and my analysis, link is in the description below. But I'm really looking at intently at the 2-year Treasury note futures, because if this is the last rate hike, this, in my view, will rocket and will continue to rocket for weeks to come. You can see this is the most volatility we've ever seen in the 2-year note, really since the 1987 crash. And, we've had the largest 3-day move in the 2-year Treasury note, and we've had the largest, also the largest drop in 3-day drop in the 2-year Treasury. So, this is really the play that I'm looking at. It's no secret that I'm looking to go long the 2-year Treasury note, meaning I'm betting that the 2-year Treasury yield will drop eventually. And this happens, right after the Fed pauses. You could see the humongous drop in the 2-year Treasury yield, which means that the 2-year Treasury note will rocket. So to me, that is the easy money play. It's not in the stock market. It's in the Treasury yields. 1 minute until the Fed decision. Let's see what CNBC is talking about, and I will take your questions. Hit that thumbs up, guys, if you were enjoying the stream and you appreciate the quality content that we try to put out. Here we go.
More than about monetary policy, but we're certainly going to hear about that and inflation in just a few seconds' time. Steve Leisman is waiting for the top of the hour, as are we, and it is here right now. Steve.
The Federal Reserve raising by 1/4 point, by 25 basis points to a new range of 4.75 to 5%. It is the 9th hike in a row since the Fed began hiking in May 2022. The Fed providing some guidance saying additional policy firming may be appropriate. And that's perhaps a bit of a downgrade from what they said last time, where they said ongoing increases in the policy rate may be appropriate. Now they're saying additional firming. We'll have to talk what that means. Now, they said recent developments, which seems like a euphemism perhaps for the recent turmoil in the banking market. They said recent developments are likely to result in tighter credit conditions for households and businesses. Those tighter credit conditions will weigh on economic activity, hiring, and inflation. The extent of these effects, however, is uncertain. Now, they left unchanged their year-end projection for the funds rate at 5.13%, which suggests they believe they'll be hiking at least 1 more quarter point and then be done. They raised next year's funds rate projection to 4.3%, which you'll notice is below the projection for the year-end. So there are some cuts built in by the Fed next year, but a little bit less than there had been before. They forecast a bit more inflation this year at 3.6 versus 3.5 for the core PCE. They said inflation remains elevated. Remember last time they said it had eased somewhat. That was gone from this particular statement. They said the U.S. banking system remains sound and resilient. On the economy, modest growth in spending and production, they've noted. Job gains have picked up and running at a robust pace. Guys, the one thing I'll notice from this thing is first the change in language for some additional firming may be appropriate. The other thing is almost no connection at all from their comments about the impact of tighter credit to the effects on the economy with policy, except for that little squishy language about what happens next. Kelly?
All right, Steve, thank you. Stick around. We have the markets shooting higher in response to this. But as we know, we get the kind of post-2 p.m. reaction, and then we get the Fed press conference reaction, then we get the closing bell reaction, and then we get the rest of the week. And by the way, Powell doesn't have a great track record for risk assets in that regard. But right now, the complex looks positive. The NASDAQ is up 0.5%. The Dow is up about 26 points. A similar move for the S&P 500 as well. Let's bring back our panel. Bob Pisani, Rick Santelli, watching the market action for us. Rick, let's start with you. What do you see in the 10s, 2s, and everywhere else?
2s and 10s dropped rather dramatically. 2s especially dramatically. We dropped to 393, and then it popped up to over 4%. On the 10-year note, I saw the market get very close to kind of 348, 349 area before it popped just a bit. The dollar index did the same thing. It dropped a bit. So what are we looking at in macro simple terms? We're looking at interest rates moving lower across the curve. We're looking at equities, and I'm sure Bob will get to that in a minute, not looking too badly. Everybody, of course, is monitoring what's going to happen with the next set of Fed meetings that happens in May. Are they going to do a quarter point or not? That's how it's turned so quickly. But there's nothing surprising here. Every trader I talked to was looking for 25. A few were actually looking for 50. Every trader I talked to thought stocks would be the better of it, and that all markets that they monitored, from interest rates to the currency markets with respect to outside the dollar, all these markets were going to rally, and they have been correct. And I will go on record thinking that the press conference is not going to take this away. I think the press conference, if anything, is going to accelerate these moves.
Bob, what do you make of it? We've seen a seesaw where stocks dipped lower, and now they're kind of trying to claw into these gains. Where's your attention focused?
Well, there were two options here, assuming that a 25 basis point hike was what happened, and that is what happened. So the Fed could either pause and specifically, explicitly signal that they're pausing, or they could hike and simply say the economic conditions are a little uncertain. And it seems to be the latter one, and I don't think that's necessarily a bad thing. So this phrase, additional policy firming, may be appropriate. Well, okay, they're saying maybe we'll hike in the future, but that's a much, much weaker version of their prior statements, a much weaker way of saying that we might rise. So that's certainly a bit bullish. And then the failure to really acknowledge the banking crisis is kind of striking. They said recent developments are likely to result in tighter credit conditions, but the effects are uncertain. That's a nod, but it's a pretty weak nod. So the implications here is that they are dealing with the crisis. They're still not entirely sure what the outcome is here. So I would say that this is a pause, but a very, very weak form of the pause, just enough to make the markets satisfied. The real worry for the market was what happens if they explicitly said, we're sorry, the banking crisis, we have the tools to deal with this, and we are not done fighting inflation, and we are not necessarily going to stop our interest rate hikes. That would have been a major problem. That's not what happened here, and that's why I think we're getting this modest rally right now.
David, what do you hear in the statement as we look at the famous octabox? This is my favorite thing. 8 people in one box.
It's a thing of beauty.
It's a thing of beauty. What do you make of the statement as we covet the octabox, and the fact that their prediction of core PCE or inflation is up from what it was, not down?
Well, on the inflation number, I'm not surprised by that because our own models were saying that, inflation's coming down.
All right. So you guys heard it there. We will obviously be streaming Jerome Powell's speech, which is going to be in 24 minutes. We'll be having it live here. But you guys heard the interest rate decision, 25 basis points as expected. More importantly, said that they are likely to hike based on the Fed's dot plot. They're likely to hike another 25 in the next meeting and then pause, right? So, they indicated that the Fed rate increases are near the end. Shout out to those of you that took the ZT play. ZT, of course, if you guys are fans of this channel, you know that this is the 2-year Treasury note futures. I sent out my detailed analysis this morning on what I think the optimal play is on the 2-year Treasury note futures. And I even said that, if you aren't comfortable yet trading futures or aren't approved, there are ETFs that you can leverage in order to trade the rise in the 2-year Treasury note futures and the decline in the 2-year yield. See, the reason that I was so bullish on the 2-year Treasury note futures is because, if you look historically, as I said before, the 2-year note is the one that is most affected by the Fed funds rate, not the 10-year. Everyone talks about the 10-year because the 10-year is the one that corporations usually use to base their interest rates off of, right? So your mortgage is based off the 10-year. Car loans are normally based off the 10-year, et cetera. But the Fed funds rate is an overnight rate. So it only makes sense that it affects the short-term rate, not the long-term rate. Long-term rates are affected more so by what's going on in the economy. So, if bond investors are looking for somewhere to park their cash for the long term and they're afraid of inflation, then they might park their money in the long-term bonds, right? Which is why you see the bond yield inversions occur, because people are pouring their money into the 10-year and ignoring the shorter term treasuries. But when the Fed pauses, the 2-year Treasury yield tanks, which means that the 2-year Treasury note rallies, right? So this is why when we get near a pause, I'm very interested in taking the 2-year Treasury futures long. But a lot of people aren't comfortable trading futures or don't have the capital or the know-how to trade futures, and that's okay. So there are true 2-year Treasury note ETFs and short-term Treasury ETFs that you can buy and sell just like a stock that also pay dividends. That you can use to leverage this trade as well. So, the 2-year Treasury yield hit the highest level since 2007. And this is why you see the 2007 bottom here on the 2-year Treasury note. But after the Fed pauses, you tend to see these things rocket, right? As the 2-year Treasury yield tanks. So, I do think that there is quite a bit of time left for this trade, and we could be monkeying around in here for a while. But initially, we saw a surge in the 2-year Treasury note future. So hopefully that makes sense. We will obviously be covering Jerome Powell live here in just around 20 minutes. Again, there's only 742 likes. There's 2,200 of you here. Take 1 second, give it a thumbs up. I swear to God, if we hit 2,000 likes, I'm gonna do a giveaway, a huge giveaway, and you guys want to see that. I will pick any of you at random, and I'll do a giveaway. But yeah, and again, if you want access to my analysis, the 2-year note what I think that the market is going to do. If you want access to my live trades and whatnot, link is in the description below. Come join us. Be a part of the academy. Also get access to all of the course videos. We're doing a Zoom call this weekend. We're doing a mastermind Zoom call this weekend. So you definitely want to be a part of that. You will know right away, shortly thereafter, if you are approved, if your application is approved or not. We see that the NASDAQ rocketing. Let's check on the S&P 500. We see the S&P 500 rocketing as well. Actually, wait, was that the NASDAQ? Oh, they have almost identical charts. This is what we call algorithmic trading. Almost identical charts, almost identical wicks. Squeezing the F out of bears. Again, this is why I was telling people, do not buy puts for today. Today is not the day you want to buy puts, especially if the Fed doesn't come in and do something drastic. And especially with this right here. Watch the age of easy money, and you will understand why the market is addicted to easy money, why the money is addicted to the Fed spigot, right? So especially with this bank term funding program here, it's more liquidity to the market. All right. A dinner date with Z. Omar, chill, bro. I cannot like enough, bro. Z, can I get a reaction video to my videos? Press to burst? I have no idea what you do. What are you, a pimple popper? I don't know. It looks like that's is your channel about popping pimples? I wouldn't watch that, unfortunately, and then I apologize. Really cheaper puts to print. Market initial direction is usually the wrong one. I wouldn't say it's the wrong one, but it's usually the one that contains the most overreaction. But I agree with you. You want to wait until Jerome Powell speaks, before actually assessing whether we are in the clear or not. Because Jerome Powell can easily come out and say, yes, 25 basis point rate hike. Yes, here's the Fed dot plot, but we are going to keep our foot on the gas, and there's no sign of pausing, right? He could say that and, ruin everybody's party for today. But again, in my view, I know how the markets work. If inflation continues to decline year over year, and the easy money taps are turned on, you can expect the market to continue rallying, to at least that 4,300 level. That's my view. Inflation would have to come in a lot higher than expected to ruin the party. Because if the Fed says, if Jerome Powell comes out today and says 25 basis points today, 25 next time, and then a pause, but then inflation comes in significantly higher, oh my God, then, they'll be forced to go back to the drawing board and turn up the volume on the Fed funds rate hikes, right? So, Anonymous, thank you so much for your $20 donation. I know I missed a few. $5, thank you so much, Anonymous, for donating $5. Harley Davidson, appreciate your $5 donation. Another Anonymous $20 donation. Eternal Soul, thank you so much for your $20 donation. Appreciate you. Wow, you guys are really killing it today. Thank you guys so much. And we did get a comment on our last live stream by St. Jude's themselves. St. Jude's last time coming in saying, thank you for all the work that you guys are doing. So I know they appreciate it too, and we are finally on the radar. After 2 years of doing St. Jude live stream donations, they finally took note and actually left a comment on our YouTube channel. So appreciate you guys. Thank you guys for the work you're doing. I know they appreciate it as well. All right, let's see. Giveaway, please. Hey, if we get to 2,000 likes, I promise you I'll do a huge giveaway. All right. T Black, appreciate your donation. Harley Davidson, another donation. Appreciate you. What's the ticker for some 2-year note ETFs? Nick Roy, check the Academy. I left all of the ETFs in the Academy. They'll monkey around a bit before the moves. Yeah, hit the like button. Powell has the most stressful job in the world. You think? I don't know, bro. Powell has the most stressful job in the world? I don't think so. The dude is worth like $50 to $100 million. I don't think he has the most stressful job in the world. No. Make the Discord monthly. Tony Killa. Okay. You guys want a monthly Discord? If you get the likes to 1,500, I promise you I will open up a monthly membership finally. If you guys get to 2,000 likes, I will do a major giveaway. Okay? He did try to box me once, but he kept missing. Yeah, because you're 5'5", bro. Gunmetal, currently in Rome. Look at you. Look at you, Gunmetal. Damn, a cultured man. Finally left the UK. Currently in Rome. Watching the stream whilst on a break from filming. Cool, man. Appreciate you, man. Always. Gunmetal, the first ever member of the Discord in 2018. First ever member. Gunmetal. Come back out to LA, bro. We need to have another meet and greet. Hadrami, did you say Zub or Zoom this weekend? Do you trade with any algorithms? Any algorithms? No, man. Don't pay for any of these bot trades, okay? Don't pay for any bot trades. They're just taking your money. There are no bot trades that are available to retail that will consistently make you money. Rely on your own ability to make money, okay? S&P 500. Wow, nice move into this imbalance here. I would have taken this long, at least until, and closed it right before Powell speaks, and then went from there. Very nice move on the S&P 500. On the day, there isn't, it's rather muted because the 25 basis points was expected. So the S&P is only up 0.2%. NASDAQ is only up on the day 0.66%. And the Dow is up on the day 0.02%. So, the expected move is creating a rather muted day so far, waiting for Jerome Powell to speak. In 13 minutes, we will have Jerome Powell speaking. Chat GPT trades coming soon. $1 million, Neo or Palantir. You're funny, Antonio. Why don't you take that $1 million and why don't you throw it in an actual blue chip ETF and thank me later? LA in June. See you then. Yo, whoa, Gunmetal. Yes. Hit me up, bro. Everyone smash that like button. Come on, 2 seconds. Exactly. And if we get this to 1,500 likes, I will open up a monthly. I promise you. And if we get it to 2,000 likes, I will do a huge giveaway. I joined the Discord last week. Well worth it. Paid it off already. Appreciate you, Glenn. Thank you so much. Yeah, man. We aren't the most. We don't send out, the most trades, because for us, trading is not about activity. It's about quality. So, we definitely are very selective in the trades that we send out with an extremely high win rate. Because we're not all about activity. I'm not going to send trades just to send trades. It's all about quality. A lot of days we have one trade, literally one trade sometimes. There are 2 other analysts that also help out, and they also both have a very high win rate. But it's all about quality, not quantity. Insane volatility on Tesla. Let's take a look at Tesla. Overall, Tesla's flat, down 0.02%. So really almost a 0% move. But yes, if you look at the intraday chart, this looks very crazy, guys. This definitely looks very crazy, especially since the Fed has released their interest rate hike decision. We're seeing huge moves on intraday candles, but if you zoom out and you look at Tesla, it's a very muted move so far. But yes, I agree with you. Insane volatility on Tesla for sure. NASDAQ to the moon now. What did I tell you? That is the trade that I would have taken. Where's my 5-minute chart? Or was that on ES? Sorry, that was on ES. Even that, yeah, I would have traded this imbalance, closed it, right before the Fed meeting. But this was an easy, 10-point move on ES futures, which would have netted you $500 per contract. I love NVIDIA. What was the basis point rate hike? 0.25%. 3K likes, live boxing event with Omar. Omar, you don't want to get murdered, bro. You don't want to get murdered on live. Dr. Cortex, the hot trader. Who are we? What are you guys talking about? Papa Powell speaks gap fills. I'm literally asking ChatGPT what trade to take in anticipation of JP's speech, and it probably won't tell you. Alex, good luck with filming in NY. I thought Z would say, take the money and flush it down the toilet instead. I mean, Antonio, why are you bullish on Palantir? This is what I want to know, okay? My Neo, maybe I can see, even though I'm not a fan of Chinese stocks. But why are you bullish on Palantir? Most people who are bullish on Palantir have no fucking idea what Palantir does. Tell me why you were bullish on Palantir. And tell me what you think Palantir does without Googling it, okay? And I will know by your answer. Without putting it in ChatGPT or Googling it, what do you think Palantir does? I'm dying to know. And why would you put $1 million in there? Is Bloodbath and Beyond going bankrupt? Yeah, I think so. Maybe. Do you trade like ICT? I do like a lot of ICT concepts. Yes. Am I a strict ICT trader? No, definitely no. I have been trading for a long time, and there are certain things that I focus on outside of the strict ICT model that I still utilize in my trading. So no, but I'm not a ICT trader, but do I like his concepts? Yes, I do think that if you backtest this enough, the concept of liquidity runs, which he has a certain way of teaching them. Liquidity is not liquidity in and of itself is not an ICT concept, but he does have a strict way of teaching that. But the concept of taking liquidity, the concept of looking for imbalances in specific fair value gaps, for instance, the concept of order blocks, I do think that there is a lot of value in that, and that he brought a lot of value to the trading game for sure. But am I a strict ICT trader? No, I think that I take those concepts along with other things that have done me well over the years, and I combine them and have my own way of reading the markets. But there isn't one way to do something, right? And I think that goes without saying. I got CivB stock before it stopped trading. What are my options? Why would you do that? What is your chess rating? Probably very low, because I don't practice chess on a daily basis. Why would you buy CivB? Is it because of Kramer? What are your options? Your options are they're going to get delisted, and you will be settled in cash for either your unrealized loss or gain. Eric K, where's Jack Ma? You love this, Eric, because I told you last time Jack Ma is sitting in a prison in the middle of Mongolia, and you cracked up. Just bought Tesla at the money calls. Amy Rebecca, what's going on, Amy? Amy is a new member of the Academy. Everyone hit the like button, please. Yeah, I mean, it seems like Team RP wants a monthly Discord membership. And by the way, if I do open a monthly Discord membership, obviously you're not going to get access to the Zoom calls or, the course videos or whatever. But a lot of people have said that they just want access to the Discord itself. And I said, if you guys get it to 1,500 likes, I will entertain that. So Fed is uncertain about banks. No, the Fed knows exactly what it's doing with banks. It's right here. This is from the Fed's website, Bank Term Funding Program. They are going to provide advances in an unlimited amount to any bank that wants them. It's going to be a loan. Here's the terms of the loan. This is what's leading to the Fed balance sheet increasing by $300 billion in a week. And tomorrow we will see by how much more the Fed balance sheet is going to increase. So no, the Fed's not worried about banks. At 2:30, hush. Straddle J. Powell's speech. Straddles are expensive right now, man. Look up the price of straddles, right? The straddle is expecting. Okay, if you do a 0 DTE straddle, I honestly think that you are much better off with an iron condor. This is what I sent out this morning. Okay, because if you do a straddle 0 DTE and it doesn't move by, see, your straddle would have been destroyed by now, by the way. Okay, because as I said this morning, if it doesn't make the expected move, your straddle is going to get obliterated. And right now we are only at 0.13% gain on the day. Yes, if you take a look at the intraday candles, they're going haywire, but they're going haywire and going haywire while remaining at the same level. They're going well above that, well below that, and then stabilizing at the same level. So if you did a straddle or a strangle, you would lose all your money right now. And I don't think that the Fed speech or Jerome Powell's speech is, especially since they did 25 expected, and especially since the dot plot already came out, I don't think that you're going to get the expected move. You need the S&P to move today by plus or minus 5 on the SPY in order to see any money on the straddle, and that's just to break even. If you do Friday's expiration, you need it to move by almost $8 just to see any money on the straddle, right? Learn what strategies are good for you. In my view, as I stated in the Discord, and I sent out my plays this morning, I said, if you are going to play FOMC, what you want to do is wait for the overreaction candle, which is this one, and you want to sell a call spread at the top of this, then wait for the overreaction to the downside and sell a put spread. And you're creating an iron condor, okay? That is probably your best bet. But trying to play a straddle when, intraday volatility is high, but the overall move, if you look at the daily candle, is super muted, you're going to lose all of your money to a play that you didn't have to take. And then plus in my pre-market analysis or my market open analysis this morning, I said that you are much better off waiting for FOMC and then trading Thursday, Friday, maybe Monday, Tuesday, all next week, playing the post-FOMC reaction. You're going to get price action that delivers a lot more cleanly, right? So, yeah. 2 minutes to Jerome Powell. 2 minutes. Opinions on Forex trading. Is it a scam? No, it's not a scam. But it's hard like every other form of trading. Yozi, thank you for all the knowledge. Has significantly helped me as a young adult. Appreciate you, David. Keep doing your thing. Keep doing your thing, man. It's, the younger, the better when it comes to trading, because you're putting in all that experience. And also, as your career grows, you give yourself the opportunity to, hoard blue chip quality stocks over the long term, right? And before you know it, you're going to be 35 or 40 and have a nice portfolio that you started when you were, in your early 20s. Amy, so excited for the futures class. Yes, I'm going to be doing a new futures course that I will release. Obviously, anyone who's, who has access to the courses will get that course for free. But I'm going to be doing a new futures course. And then Amy, also the Zoom Mastermind is this weekend. I know you just joined yesterday, but the Zoom Mastermind is this weekend as well. The younger, the better. Nick, stop being a dickhead. Yes, the younger, the better, obviously, when it comes to trading, right? Or investing. the younger you are and the more that you can accumulate stocks in your early 20s, by the time you're 35, 40, you have a fucking huge portfolio that's paying you dividends. But yeah, let's go to CNBC. Let's hear where Jerome Powell's at. And by the way, if Jerome Powell, actually, you know what? I'll look up the YouTube video real quick, or the YouTube, the Fed YouTube, and see if he's talking there. Oh, actually, right here.
Him right now. Thanks.
Good afternoon. Before discussing today's meeting, let me briefly address recent developments in the banking sector. In the past 2 weeks, serious difficulties at a small number of banks have emerged. History has shown that isolated banking problems, if left unaddressed, can undermine confidence in healthy banks and threaten the ability of the banking system as a whole to play its vital role in supporting the savings and credit needs of households and businesses. That is why, in response to these events, the Federal Reserve, working with the Treasury Department and the FDIC, took decisive actions to protect the U.S. economy and to strengthen public confidence in our banking system. These actions demonstrate that all depositors' savings and the banking system are safe. With the support of the Treasury, the Federal Reserve Board created the Bank Term Funding Program to ensure that banks that hold safe and liquid assets can, if needed, borrow reserves against those assets at par. This program, along with our long-standing discount window, is effectively meeting the unusual funding needs that some banks have faced and makes clear that ample liquidity in the system is available. Our banking system is sound and resilient with strong capital and liquidity. We will continue to closely monitor conditions in the banking system and are prepared to use all of our tools as needed to keep it safe and sound. In addition, we are committed to learning the lessons from this episode and to work to prevent events like this from happening again. Turning to the broader economy and monetary policy, inflation remains too high and the labor market continues to be very tight. My colleagues and I understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. The U.S. economy slowed significantly last year, with real GDP rising at a below-trend pace of 0.9%. Consumer spending appears to have picked up this quarter, although some of that strength may reflect the effects of swings in the weather across the turn of the year. In contrast, activity in the housing sector remains weak, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. Committee participants generally expect subdued growth to continue. As shown in our summary of economic projections, the median projection for real GDP growth stands at just 0.4% this year and 1.2% next year, well below the median estimate of the longer-run normal growth rate. And nearly all participants see the risks to GDP growth as weighted to the downside. Yet the labor market remains extremely tight. Job gains have picked up in recent months, with employment rising by an average of 351,000 jobs per month over the last 3 months. The unemployment rate remained low in February at 3.6%. The labor force participation rate has edged up in recent months, and wage growth has shown some signs of easing. However, with job vacancies still very high, labor demand substantially exceeds the supply of available workers. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing upward pressures on wages and prices. The median unemployment rate projection in the SEP rises to 4.5% at the end of this year and 4.6% at the end of next year. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in January, total PCE prices rose 5.4%, excluding the volatile food and energy categories. Core PCE excluding those, core PCE prices rose 4.7%. In February, the 12-month change in the CPI came in at 6%, and the change in the core CPI was 5.5%. Inflation has moderated somewhat since the middle of last year, but the strength of these recent readings indicates that inflation pressures continue to run high. The median projection in the SEP for total PCE inflation is 3.3% for this year, 2.5% next year, and 2.1% in 2025. The process of getting inflation back down to 2% has a long way to go and is likely to be bumpy. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by a quarter percentage point, bringing the target range to 4.75% to 5%. And we are continuing the process of significantly reducing our securities holdings. Since our previous FOMC meeting, economic indicators have generally come in stronger than expected, demonstrating greater momentum in economic activity and inflation. We believe, however, that events in the banking system over the past 2 weeks are likely to result in tighter credit conditions for households and businesses, which would in turn affect economic outcomes. It is too soon to determine the extent of these effects, and therefore too soon to tell how monetary policy should respond. As a result, we no longer state that we anticipate that ongoing rate increases will be appropriate to quell inflation. Instead, we now anticipate that some additional policy firming may be appropriate. We will closely monitor incoming data and carefully assess the actual and expected effects of tighter credit conditions on economic activity, the labor market, and inflation. And our policy decisions will reflect that assessment. In our SEP, each FOMC participant wrote down an appropriate path for the federal funds rate based on what that participant judges to be the most likely scenario going forward. If the economy evolves as projected, the median participant projects that the appropriate level of the federal funds rate will be 5.1% at the end of this year, 4.3% at the end of 2024, and 3.1% at the end of 2025. These are little changed from our December projections, reflecting offsetting factors. These projections are not a committee decision or plan. If the economy does not evolve as projected, the path for policy will adjust as appropriate to foster our maximum employment and price stability goals. We will continue to make our decisions meeting by meeting based on the totality of the incoming data and their implications for the outlook for economic activity and inflation. We remain committed to bringing inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening in labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
I wonder if they're going to ask him about the increasing balance sheet. I hope somebody asks him.
The committee that the recent stress that we've seen and you've alluded to is contained at this point, and that deposit flight among mid-sized lenders in particular has ceased.
Thanks. So I guess our view is that the banking system is sound and it's resilient. It's got strong capital and liquidity. We took powerful actions with Treasury and the FDIC, which demonstrate that all depositors' savings are safe and that the banking system is safe. Deposit flows in the banking system have stabilized over the last week. And the last thing I'll say is that we're undertaking a thorough internal review that will identify where we can strengthen supervision and regulation.
Okay, just a quick follow-up. I mean, given all of the stress and the uncertainty that you've also alluded to in the statement, how seriously was a pause considered for this meeting?
So we did consider that in the days running up to the meeting, and you see the decision that we made, which I'll say a couple things about. First, it was supported by a very strong consensus, and I'll be happy to explain why. And really it is that the intermeeting data on inflation and the labor market came in stronger than expected, and really before the recent events, we were clearly on track to continue with ongoing rate hikes. In fact, as of a couple of weeks ago, it looked like we'd need to raise rates over the course of the year, more than we'd expected at the time of the SCP in December, the time of the December meeting. We are committed to restoring price stability, and all of the evidence says that the public has confidence that we will do so, that we'll bring inflation down to 2% over time. It is important that we sustain that confidence with our actions as well as our words. So we also assess, as I mentioned, that the events of the last 2 weeks are likely to result in some tightening of credit conditions for households and businesses, and thereby weigh on demand, on the labor market, and on inflation. Such a tightening in financial conditions would work in the same direction as rate tightening. In principle, as a matter of fact, you can think of it as being the equivalent of a rate hike, or perhaps more than that. Of course, it's not possible to make that assessment today with any precision whatsoever. So our decision was to move ahead with a 25 basis point hike and to change our guidance, as I mentioned, from ongoing hikes to some additional hikes, maybe some policy firming may be appropriate. So going forward, as I mentioned, in assessing the need for further hikes, we'll be focused, as always, on the incoming data and the evolving outlook, and in particular on our assessment of the actual and expected effects of credit tightening.
Mr. Chairman, can you explain the difference between ongoing rate increases and firming? Does firming imply a rate increase per se, or could policy firm without you increasing rates?
No, I think it's meant to refer to our policy rate. Really, I would focus on the words may and some, as opposed to ongoing. So we clearly were, what we were doing there was taking on board trying to reflect the uncertainty about what will happen. I mean, it's possible that this will turn out to have very modest effects. These events will turn out to be very, very modest effects on the economy, in which case, and inflation will continue to be strong, in which case, the path will might look different. It's also possible that this potential tightening will contribute significant tightening in credit conditions over time, and in principle, if that means that monetary policy may have less work to do. We simply don't know. Do
you have concerns that the hike you did today could further exacerbate the problem in the banks?
No, I mean, with our monetary policy, we're really focused on macroeconomic outcomes. In particular, we're focused on this potential credit tightening and what can that produce in the way of tighter credit conditions. I think when we think about the situation in the banks, we're focused on our financial stability tools, in particular our lending facilities, the discount window, and also the new facility.
Nick Timmeros of the Wall Street Journal. Chair Powell, in your testimony 2 weeks ago, you had indicated you thought the terminal rate would be higher. Obviously, that was before the stress in the banking sector. And I realize there's a lot of uncertainty, but can you explain at all to what extent your forecasts or those of your colleagues or those of the board staff incorporated today a material tightening of credit availability because of the stress in the banking sector, or are you waiting to see it in the data before you incorporate that potential tightening into your forecasts?
So, we've just come from an FOMC meeting, and the people who write the minutes will be very carefully counting. But I'll tell you what I heard. What I heard was a significant number of people saying that they anticipated there would be some tightening of credit conditions, and that would really have the same effects as our policies do, and that therefore they were including that in their assessment, and that if that turned out not to be the case, that in principle you'd need more rate hikes. So some people did reflect that, in their SEP forecasts. I think there may also just have been, remember, this is 12 days ago. We're trying to assess something that just is so recent, and it's people, it's very difficult. There's so much uncertainty. So December was a good place to start, and we wound up with very similar outcomes for December. And in a way, the data in the first part, the first 5 weeks of the intermeeting period, pointed to stronger inflation and a stronger labor market. So that pointed to higher rates, and then this latter part, kind of the possibility of credit conditions tightening, really offset that effectively.
To follow up, have you considered at all whether your primary tool, the funds rate, is going to be enough to sustain the kind of tighter financial conditions that you believe will be necessary without doing significant damage to the banking sector? Have you, for example, considered changing reserve requirements, selling assets out of the system open market account as a way to better achieve tighter financial conditions that don't accelerate deposit erosion, for example, from banks?
We know that we have other tools in effect, but no, we think our monetary policy tool works, and we think, many banks, our rate hikes were well telegraphed to the market, and many banks have managed to handle them.
Victoria.
Hi, Victoria Guida with Politico. I wanted to ask, you, along with the FDIC and the Treasury, the Fed board decided to invoke the systemic risk exception to allow uninsured depositors to be protected at these two banks. And I was just wondering if you could speak to why that decision was made. Was it purely a confidence issue, or was there a concern that there would be some sort of economic contagion or financial contagion from the failure of these banks?
The issue was really not about those specific banks, but about the risk of a contagion to other banks and to the financial markets more broadly. That was the issue.
Okay, and then can you also, just to follow up, can you speak to the role that you will be playing in the Fed's internal investigation on its supervision and regulation? So
Vice Chair Barr is of course leading that review, and he's responsible for it in his capacity as Vice Chair for Supervision. I realized right away that there was going to be a need for a review. I mean, the question we were all asking ourselves over that first weekend was, how did this happen? And what we did was early Monday morning we sat down and said, let's do this, and he was obviously going to lead it in his capacity. So I don't, my role was to announce it, and I get briefed on it, but I'm not involved in the work of it.
Hi, Chair Powell. Howard Schneider from Reuters. So I want to go back to your February press conference. You mentioned the word disinflation, I believe, 9 or 10 times, a process that you felt was, I forget the word you used, but gratefully underway or something like that. Is disinflation still occurring in the U.S. today?
Yes. I mean, what actually happened, Howard, was I got the question 12 times. So maybe it's a feature, not a bug. But But yeah, absolutely. Absolutely, the same. The story is intact. So it's really three parts, right? Goods inflation's been coming down now for 6 months. It's proceeding more slowly than we would have liked, but it's certainly proceeding. Housing services is really a matter of time passing. We continue to see the new leases being signed at much lower levels of inflation. So that's 44% of the core PCE index, where you've got a story that's ongoing. Where we didn't have in February, and we still don't have now, is a sign of progress in the non-housing services sector, and that is, that's just something that will have to come through softening demand, and perhaps some softening in labor market conditions. We don't see that yet, and that's of course 56% of the index. So the story is pretty much the same. I will say that the inflation data that we got, to your point, really pointed to stronger inflation.
If I could follow up on that, I was curious why you don't see more coming from the credit crunch, because it seems to me that's something that you'd actually welcome to a degree and expect. And are you not seeing more coming from that because you don't know, or because you just don't want to have another round of wishful thinking?
So it's really just a question of not knowing at this point. There's a great deal of literature on the connection between tighter credit conditions, economic activity, hiring, and inflation. Very large body of literature. The question is, how significant will this credit tightening be, and how sustained will it be? That's the issue. And we don't really see it yet. It's so people are making estimates, people are publishing estimates, and but it's very kind of rule of thumb guesswork almost at this point. But we think it's potentially quite real, and that argues for being alert as we go forward, as we think about further rate hikes. For us, we'll be paying attention to the actual and expected effects from that.
Hi, Chair Powell. Gina Smilek from the New York Times. Thank you for taking our questions. I wonder if you could talk a little bit, I know that you've got your internal review coming, but I wonder if you could talk a little bit about what you think happened with oversight at Silicon Valley Bank and whether this suggests that something about regulation and supervision needs to actually change going forward. And I wonder, how can the American people have confidence that there aren't other weaknesses out there in the banking system, given that this one got missed, as you noted?
So let me say what I think happened, and then I'll come to the questions around supervision. So at a basic level, Silicon Valley Bank management failed badly. They grew the bank very quickly. They exposed the bank to significant liquidity risk and interest rate risk, didn't hedge that risk. We now know that supervisors saw these risks and intervened. We know that the public saw all this. We know that SVB experienced an unprecedentedly rapid and massive bank run. So this is a very large group of connected depositors, concentrated group of connected depositors, and a very, very fast run, faster than the historical record would suggest. So as for us, so for our part, we're doing a review of supervision and regulation. My only interest is that we identify what went wrong here. How did this happen is the question. What went wrong? Try to find that. We will find that. And then make an assessment of what are the right policies to put in place so that it doesn't happen again, and then implement those policies. It would be inappropriate for me at this stage to offer my views on what the answers might be. I simply can't do that. Vice Chair Barr is leading this, and I think he's testifying next week. So, but that will be up to him. So that's really where it is. The review is going to be thorough and transparent. It is clear, to your last question, it's clear that we do need to strengthen supervision and regulation. And I assume that there will be recommendations coming out of the report, and I plan on supporting them and supporting their implementation.
Sorry, and the final point, can we feel confident that these weaknesses don't exist elsewhere, given that they got missed at this bank?
These are not weaknesses that are at all broadly through the banking system. This was a bank that was an outlier in terms of both its percentage of uninsured deposits and in terms of its holdings of duration risk. And again, supervisors did get in there, and they were, as you know, obviously, they were on this issue, but nonetheless, this still happened. And so that's really the nature of the of the review, is to discover that.
Michael McKee from Bloomberg Radio and Television. You've been very consistent in saying that the Fed would be raising interest rates and then holding them there for quite some time. Following today's decision, the markets have now priced in one more increase in May, and then every meeting the rest of this year, they're pricing in rate cuts. Are they getting this totally wrong from the Fed, or is there something different about the way you're looking at it, given that you're now thinking that moves might be appropriate as opposed to ongoing?
So we published an SEP today, as you will have seen, and it shows that basically participants expect relatively slow growth, a gradual rebalancing of supply and demand in the labor market, with inflation moving down gradually. In that most likely case, if that happens, participants don't see rate cuts this year. They just don't. I would just say, as always, the path of the economy is uncertain, and policy is going to reflect what actually happens rather than what we write down in the SEP. But that's not our baseline expectation.
Well, if I could follow up and ask, as you look forward into the rest of the year here, are you saying that what you see and the 5.1% basically consensus is based on it will be sufficiently restrictive, or is it leavened by the idea of you don't know what's going to happen? In other words, what should people think about in terms of how the Fed thinks about how far it is from the terminal?
It's going to depend. Remember, we're looking, for purposes of our monetary policy tool, we're looking at what's happening among the banks and asking, is there going to be some tightening in credit conditions? And then we're thinking about that as effectively doing the same thing that rate hikes do. So in a way, that substitutes for rate hikes. So the key is we have to have policies got to be tight enough to bring inflation down to 2% over time. It doesn't all have to come from rate hikes. It can come from, tighter credit conditions. So that we're looking at, and it's highly uncertain how long the situation will be sustained or how significant any of those effects would be. So we're just going to have to watch. In the meantime, and obviously at the end of the day, we will do enough to bring inflation down to 2%. No one should doubt that.
Let's go to Rachel Siegel.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thank you for taking our questions. I know we've talked a bit about how Silicon Valley Bank was unique to a certain sector of the economy, but there's also growing concern that there are financial stability risks from the commercial real estate market and loans that will begin to roll over later this year and next, and that smaller regional banks also disproportionately hold those loans. Is there a risk that could mimic the kind of what we saw with SVB to banks that disproportionately are focused in commercial real estate?
So, we're well aware of the concentrations people have in commercial real estate. I really don't think it's comparable to this. The banking system is strong, it is sound, it is resilient, it's well capitalized, and I really don't see that as at all analogous to this.
Question, would you be open to an independent investigation separate from the Fed's probe?
I welcome. It's 100% certainty that there will be independent investigations and outside investigations and all that. So we welcome, when a bank fails, there are investigations, and of course, we welcome that.
Edward.
Thank you, Mr. Chairman. Edward Lawrence from Fox Business. Inflation has been rather sticky, so do you need help from the fiscal side to get inflation down faster?
We don't assume that. We don't give advice to the fiscal authorities, and we assume that we take fiscal policy as it comes to our front door, stick it in our model along with a million other things, and we have responsibility for price stability. The Federal Reserve has responsibility for that, and nothing is going to change that. So we will get inflation down to 2% in time.
And if I can follow on that, but they're working, the spending that's happened is working against what you are doing, right? So it's prolonging inflation?
If you have to look at the impulse from spending, because spending was, of course, tremendously high during the pandemic, and then as the pandemic programs rolled off, spending actually came down. So the sort of fiscal impulse is actually not what's driving inflation right now. It was at the beginning, perhaps part of what was driving inflation, but that's not really the story now.
Let's go to Neil Irwin.
Hi, Chair Powell. Neil Irwin with Axios. Two questions about aspects of the government's response on Silicon Valley Bank 2 weekends ago. First, why is this new bank funding facility done under Emergency 13.3 authority as opposed to expansion of the discount window, changing the terms of the discount window that's been around a long time? And second, can you discuss the Fed's role in the FDIC guarantee of uninsured depositors and why there's $143 billion on your balance sheet last week supporting that deposit guarantee?
Sure. So 13.3 seemed like the right. We have a little more flexibility under Section 13.3. We've done quite a lot under the discount window as well. We needed to do a special facility that was designed a certain way, so we did it under 13.3. Really no magic to that. It's only available in unusual and exigent circumstances, and it has to meet certain requirements, but it seemed to be the right place. So with the FDIC, we're lending to the, in effect, we're lending to the bridge bank. So that's where the funds came from, and it's a loan that's 100% guaranteed by the FDIC, so there's no risk in it for us.
Chris Rugaber.
Thank you. Chris Rugaber at Associated Press. The SEP suggests one more rate hike, as does the change in the language in the statement, in which suggests that you're perhaps nearing the end of a cycle of rate hikes. Do you feel, though, that if inflation remains high, you'll be able to resume additional hikes as needed, or have you somewhat tied your hands here with these signals about rate hikes coming to an end? Thank you. Absolutely not. No, if we need to raise rates higher, we will. I think for now, though, as I've mentioned, we see the likelihood
of credit tightening. We know that that can have an effect on the macroeconomy, on demand, on the labor market, on inflation, and we're going to be watching to see what that is. And we'll also be watching what's happening with inflation and in the labor market. So we'll be watching all those things, and of course we will eventually get to tight enough policy to bring inflation down to 2%. We'll find ourselves at that place.
Hi, Chair Powell. Thanks for taking the question. Kyle Campbell with American Banker. I have a couple questions about the balance sheet. First of all, I'm curious at what point the financial supports that the Fed is extending through the discount window and through its enhanced lending facility might be at odds with the objective of reducing the balance sheet. And I'm also curious what your thoughts are on not just the availability of reserves, but the distribution of them throughout the banking system, and at what point you might be concerned about it being scarce for certain banks.
So people think of QE and QT in different ways. So let me be clear about how I'm thinking about these recent developments. So the recent liquidity provision that has increased the size of our balance sheet, but the intent and the effects of it are very different from when we expand our balance sheet through purchases of longer-term securities. Large-scale purchases of long-term securities are really meant to alter the stance of policy by pushing up the price and down the rates, longer-term rates, which supports demand through channels we understand fairly well. The balance sheet expansion is really temporary lending to banks to meet those special liquidity demands created by the recent tensions. It's not intended to directly alter the stance of monetary policy. We do believe that it's working. It's having its intended effect of bolstering confidence in the banking system and thereby forestalling what might otherwise have been an abrupt and outsized tightening in financial conditions. So that's working. In terms of the distribution of reserves, we don't see ourselves as running into reserve shortages. We think that our program of allowing our balance sheet to run off predictably and passively is working. And of course, we're always prepared to change that if that changes, but we don't see any evidence that that's changed.
Hi, Chair. Katerina Saraiva with Bloomberg News. The minutes of the January-February meeting, the last meeting, indicate that you discussed the possibility of runs on non-bank financial institutions and the impact of large unrealized losses on bank portfolios. Can you talk a little bit more about that discussion, kind of what was talked about in light of that? And then why didn't the Fed do anything about that at that point to ultimately prevent, what happened this month?
I mean, to be honest, I don't recall the specifics of that. It's been quite an interesting 7 weeks, but I will tell you though that there have been presentations about interest rate risk. I mean, it's been in all the newspapers. It's not a surprise that there are institutions that have had unhedged long positions in long duration securities that have lost value as longer term rates have gone up due to our rate increases. So that's not a surprise. I think, as you know, as is now on the public record, the supervisory team was apparently very much engaged with the bank repeatedly and was escalating, but nonetheless, what happened happened. And so that's really the purpose of one way to think about the review that Vice Chair Barr is conducting, is to try to understand how that happened and try to understand how we can do better and what policies we need to change. I mean, one thing is the speed of I'll come back to that, the speed of the run. It's very different from what we've seen in the past, and it does kind of suggest that there's a need for possible regulatory and supervisory changes, just because supervision and regulation need to keep up with what's happening in the world.
Can you confirm whether or not the board knew about these escalations by the examiners in San Francisco?
I will have to come back to you on that. Yeah, I don't know.
Simon Urbanovich with The Economist. Thank you very much. Chair Powell, you stated twice today that all depositors' savings in the banking system are safe. Are you saying that de facto deposit insurance covers all savings? Shouldn't Congress have a say in that? And just by way of example, if a bank with less than $1 billion in assets failed, are you promising to bail out all of its depositors? Thanks.
Well, I'm not saying anything more than I'm saying. So, but what I'm saying is you've seen that we have the tools to protect depositors when there's a threat of serious harm to the economy or to the financial system, and we're prepared to use those tools. And I think depositors should assume that their deposits are safe.
Go to Greg Robb.
Thank you, Chair Powell. Greg Robb from MarketWatch. I was wondering if you could give us a little bit more color. You gave just a little bit of color. You said during the first week of the Silicon Valley weekend, you said the question you guys asked was, how did this happen when you saw Silicon Valley Bank? So I was wondering if you could go to the credit.
Can you guys hear me? I have no clue what happened. I think their server just crashed. Can you let me know if you can still see the stream? Ah, okay. Yeah, I'm not sure. I'm not sure what happened. All right, cool. Well, anyway, maybe that was a sign. So, all right, here is the I'll refresh it, but in the meantime, here's the summary. They raised by 25 basis points. He's asking questions about the balance sheet. I'm glad that someone finally asked him questions about the balance sheet. I will refresh this, all right? I will refresh it. But I'm glad that someone asked questions about the balance sheet. But he said that it won't have an inflationary effect like other purchases of treasuries, and I just don't see how that's the case, because they are pumping the banks with liquidity. Now, tomorrow at 4:30 p.m. Eastern, we will get an update on this balance sheet and see if it has increased. But they're basically, someone had asked the question on whether the banks are in trouble, and they're not. The Fed already promised that they're going to save every bank they can, and this is going to run until at least March 11th, 2024. And by the way, 62 more likes, and I will open up a monthly. 62 more likes, and I'll open up a monthly. So it's your choice if you guys want to get there or not. And by the way, we are up almost $1,000 per contract on ZT futures. For those of you that were short-term traders, you can close that position. For me, I'm going to be scaling into ZT over the next year. I do think that is the trade for when the Fed finally pauses. Let me see if we can get the stream back or not. Let me refresh this. But yeah, he basically was saying that. Oh, here we go. What the fuck is going on? Here we go.
If so, we don't know how significant it will be. And so, we're very focused on getting inflation down, because
boom, you guys hit 1,500 likes. So I'm a man of my word. I will be opening up a monthly. Make sure that you watch out for the socials, the YouTube, for those links when we finally do that. It will be coming within the next week or two.
Have been really since the high inflation period. And the reason was inflation wasn't forcing the central bank to come in and stop an incipient or an expansion. You can have very, very long expansions without high inflation. And we had several of those, and they're very good for people. You see late in expansion, you see low unemployment, you see the benefits of wages going to people at the lower end of the wage spectrum. It's just a place that we should try to get back to.
Jean.
Hi, Chair Powell. Jean Young with Market News. I just wanted to ask, with all the events of the past 2 weeks, do you still see a possibility of a soft landing for the U.S. economy?
It's too early to say, really, whether these events have had much of an effect. It's hard for me to see how they would have helped the possibility, but I guess I would just say it's too early to say whether there really have been changes in that.
All right, you guys asked me if he was dovish or hawkish, and earlier he was dovish, and now he's finally starting to sound hawkish.
The likely declines in or tightening in credit standards, credit availability. So we'll just have to see. I do still think, though, that there's a pathway to that. I think that pathway still exists, and we're certainly trying to find it.
Nancy.
He didn't sound so convinced about the soft landing now.
Marketplace. Just wondering how many financial institutions have been issued matters requiring attention or matters requiring immediate attention citations at this point?
How many? I don't know. But those are serious regulatory, particularly immediate attention. That's and I guess there were 6 of them. So.
And getting to the seriousness of it, how are you going to ensure that banks comply with these citations, take them seriously? How will you enforce them?
He can. It is right in the heart of what the review will be doing under Vice Chair Barr's leadership. So I think that's what you think about. What can we do to make sure? But again, that's not for me to answer today.
So you have specific thoughts on that?
Well, I see. If I did, I wouldn't share them because I really, this review's going on, and I want nothing other than us to find out what happened and why, figure out what we can do to do better, and then implement those changes. That's all I want. It's for me to be giving you my half-formed or partially informed thoughts. It just isn't appropriate. There's a real serious review going on with people from all over the Federal Reserve System who are not connected to this, to this work, not connected to this bank, and under again Vice Chair Barr's leadership, and I'm confident that it will produce a satisfactory result.
Okay, we'll go to Jennifer for the last question.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. Curious, how do you view financial conditions right now? If credit becomes expensive enough, choking off growth, as you said you're watching for, would that situation warrant a rate cut? What situation would warrant a rate cut? And have the bank failures prompted any discussion around changing the implementation of the balance sheet runoff? Thank you.
So we haven't really talked about changing the balance sheet implementation. That's not something we've discussed yet. As I mentioned, we're always willing to change that if we conclude that it's appropriate, but we're really not seeing any signs there. Sorry, then the question before that was, just give me a...
Curious how you view financial conditions now, and if credit were
okay.
to tighten enough, if that would prompt a rate cut.
So financial conditions seem to have tightened, and probably by more than the traditional indexes say, because the traditional indexes are focused a lot on rates and equities, and they don't necessarily capture lending conditions. So we think that, though. So there are other measures which if they're focused on, bank lending conditions and things like that, they show some more tightening. The question for us, though, is how significant will that be, and how, what will be the extent of it, and what will be the duration of it, and then, once you know that, there's a fair amount of research about how that with broad uncertainty bands, how that works its way into the economy over what period of time. And so, so we'll be looking to see the first part of that, like how serious is this, and how does it look like it's going to be sustained? And if it is, it could easily have a significant macroeconomic effect, and we would factor that into our policy decisions. I mentioned with rate cuts, rate cuts are not in our base case, so that's all I have to say. So,
thank you.
Thank you very much.
All right. Well, there you have it. The market so far reacting, like I said, he was really, really dovish the first part of the speech. Ended the speech really hawkish. For those of you that, traded an iron condor, this is or we're planning on trading an iron condor. This is the part where I would open up the put side of that iron condor spread. As I said in the morning, you want to open up the call spread when we get the first overreaction up, and then you want to open the put spread when we get the first overreaction down. and you will have your iron condor. But he sounded hawkish in the second part of that speech, where he said, further rate hikes might be needed. And then when they asked him the question about the soft landing, for the first time that I remember, in all of the FOMC meetings, Jerome Powell actually sounded very unsure about the prospect of a soft landing. Before he would just give his really empty commentary and platitudes about the soft landing scenario being the most viable one. And I mean, maybe you guys can remind me, but this is really the first time that I hear him really unsure about whether a soft landing is possible. And he says, that's still the hope, but he didn't sound too sure about the prospects of a soft landing. So, then you see the market finally take a dive. But again, this is all intraday market volatility that's meant to wipe out any calls or puts, or even worse, straddles or strangles that anybody had for today. If you look at the day in general, it's a pretty muted move. The S&P didn't make, so far, we have 45 minutes left till the market closes, but the market didn't make the expected move. We're only down 0.2% on the S&P. The NASDAQ is only down on the day. Actually, it's up on the day, sorry, 0.3%. So, any big moves that people were expecting haven't been made. And so if you had a bet on the market, especially using options that entailed or needed a big move, then those premiums actually got busted, right? So that's why I didn't decide to play a straddle or strangle. And I said your best bet probably is to open up an iron condor. You would open up the call side on the first pump reaction, which you would have done here, and then open up the put side on the first dump reaction or dump overreaction, right? So that would have been a profitable play. Obviously, we were up almost $1,000 per contract on the ZT futures, which I did send out this morning as well. You guys did smash the like, so appreciate you for that. Appreciate you for all the donations. If you guys want access to the Zoom call this weekend that we are doing, it's going to be on Saturday at noon. Join the Academy or apply to join the Academy. Link is in the description below. You also get access to over 60 course videos. We are releasing the futures course video as well. So all of you who have access to the courses will get that course for free. No need to pay anything additional. So I will be doing that. So sign up link is in the description below. You guys did actually smash the like button. So I'm going to make good on my promise and release a much more streamlined and bare bones monthly membership. You won't get access to the course videos or the Zoom calls with me, but you will get access to all of my analysis and plays in the Discord. I will open that up, so look out for the socials. Look out for my future videos where I will send out more details on that. Appreciate you, Rob, for your $5 donation. Thank you so much, man. Thank you for all the donations today. We've actually received more donations today than we have in a long while. So appreciate you guys for that. And St. Jude's appreciates you even more. For those of you that missed it, they left a comment on our last YouTube video thanking you guys for all of the donations as well. So thank you guys. Yeah, any questions that you guys want me to answer before we dip? I could see the screen but can't hear. That's your problem, Medina. The sound is working just fine. Same here. He's wishy-washy on soft landing. Yeah. Will it go back up to the fair value gap? Fair value gap doesn't denote direction. The fair value gap is a reactionary level, meaning that if you hit that level, then you likely have a potential trade, a potential trade idea. But having a fair value gap does not mean that the market will go up to fill that fair value gap, right? Like if I have this fair value gap here, it doesn't mean that the market is going to go up and fill it. It just means that it exists. And if we get there, then there's a potential trade idea. But as I said before, the market every single day is just a string of taking liquidity on both ends, which is why I said that on a day like today, you probably want to play an iron condor that you leg into, meaning opening up one side first and then the other. But we have liquidity here up on the buy side. We have liquidity here on the sell side. But just having a fair value gap here doesn't mean anything. Once we hit that level, then it might mean something. And yes, in this case, like if we did hit this fair value gap, I would, take a short if we didn't have only 40 minutes left until the market closed. In this case, besides that iron condor, there's no other trade that I would take today with only 40 minutes left. I would just wait until tomorrow and play the days or the moves following FOMC, which is likely to deliver a lot more sensible price action. To use ICT, I use some ICT concepts, but I'm not an ICT, a strict ICT trader. Kevin S., where's the link to the Discord? In the description. Where else would it be? Click the link in the description. All right, short water. Not sure what you mean. How do you think about the market? Rewind the tape. I discussed my take on the market. Has NVIDIA topped? No way to know this. I know that NVIDIA has squeezed like a mofo because there were so many bets on NVIDIA tanking, and NVIDIA has completely obliterated any and all shorts, which is crazy because people just kept shorting it blindly. You don't want to short things blindly. You want to wait until you get a confirmation that liquidity is taken. And then you want to see a break of market structure, but people really want to get the first move short. And so they keep piling into puts and getting crushed for it. Whereas if you wait patiently until liquidity is taken, you wait until market structure breaks, then, you will likely have a more optimal short to take. But I would not short NVIDIA here just nakedly. No. Do you see the bottom is in or we see new lows? I think it depends on, what happens on the next the next CPI, right? April 12th. Because if CPI comes in higher than expected, then the Fed, there's no way that the Fed does any pauses in the near term, right? So I think it really depends on the next CPI. It depends on I think there is a running story with the banks, even though I do think that the banks will just get backstopped regardless. There's still a running story because it is an indication of, how much under pressure the economy is in. But I do think that there's a potential for a credit event sometime this year that is unforeseen, either with corporate credit, with consumer credit, or both. I don't think that the big story is in the banks because if the Fed just says we're going to backstop, every single bank run, then obviously there are no bank failures, right? JAG-X, isn't that an old Zach Morris pump? I have no idea because I don't trade low float stocks like that, so I don't know. Have you tried chicken al pastor at Chipotle yet? No, but that is on my mind. I actually, during the live, one of the things I did was pull up Postmates to order Chipotle. But then I said, you know what? We only have a few minutes until market close, so I'm going to just drive to Chipotle. But I will try it. Have you tried it? I went to try it yesterday, and they were all out. What? They better not be out when I go today. Shit. We'll see. I do love al pastor. That is one of my favorite tacos. Is the actual al pastor, the pork one. But yeah, definitely. Wanting to try the chicken one for sure. But thank you guys for smashing the likes. As promised, I will be releasing that monthly. So look out for that on my socials. And make sure you take advantage of it because I will likely only open up a certain amount. I don't want the Discord to get too big. It is already, thankfully, big enough, and I want to be able to provide value and keep it manageable. Make sure that we answer people's questions, etc. So, I short any company that gives me a bad service. That's probably the stupidest thing to do. You are not hurting the company by shorting them. You are only hurting yourself by nakedly shorting something without really having an optimal A+ trade entry. Shorting a company, they could care less whether you short them. I've seen this, the sentiment before. Trust me, they could give a shit whether you, as a single retail trader, are shorting their stock. Happy Ramadan for all the Muslims. Yes, Ramadan Mubarak to anyone that celebrates. Today, I think, is the first day of Ramadan. The market will flush before close. Maybe, but I still wouldn't take it short, until we get to this level here. Oh, we did get to it. Okay. Nice. We did get to that fair value gap. Yeah, I would have taken that short, tight stop above here, 4,056, but with only a little bit of time left, it would be, if I did take this, it would just be a tiny scalp. I wouldn't leave this open. So Z is Egyptian for sure. I'm not Egyptian. Are you Lebanese? I'm not Lebanese. All right. JAG-X is rock bottom right now. Stop pumping low float stocks. All right. Would you please let us know if KRE is a good buy? What do you mean by good buy? It really depends on what you mean. This right now is still a falling knife. I don't know why you'd want to buy a falling knife. I do think that there will be an opportunity in banks. I do think it's a little bit too soon. But yeah, I think there will be an opportunity in banks. Do you want to buy regional banks where there are potential, where there's potential failures? I would stick to XLF, honestly, the S&P 500 sector, or the financial sector of the S&P 500. I do think that there is a good level to dollar cost average here. But yeah, Z is a Martian. Z has got to be Latino then. Z is our brother. Z is Iranian. Wow. Z is human. Are you Punjabi? No, I'm not Punjabi. What happens to a cash secured put when stock is delisted for whatever reason? When a stock is delisted, then whatever position that you have will be closed out. Will be cashed out for either, if you are in a loss or a gain, it will be cashed out. Jordanian. No, I'm not Jordanian. Jewish. No, I'm not Jewish. Wow, I'm getting like every single, the only thing, bro, is Mexican. The only thing that you guys haven't said that I am is Asian. That's it, right? Like, I've gotten everything except for Asian. Z, bring great success to glorious nation of Kazakhstan. Moroccan, Colombian. Wow, dude is from Guatemala. You guys are crazy. You know what? At this rate, I just won't tell you, just because I enjoy the guesses. I really enjoy the guesses. Z is Mongolian. There you go. I got some flavor of Asian. So we have officially spanned the entire globe. Brazilian, Armenian, Portuguese. All right. I'm officially Ethiopian. I am officially a racial chameleon. Happy to say so. Happy to say so. That means I could just relate to every single one of you. There you go. Pakistan. Wow. Definitely not Pakistan. Greek. I love your Spanish so much. Appreciate you, Luis. Z, Siberian. Black on black. Mixed. Wow. Area 51. That is the best fucking answer right there. Someone said I'm from Area 51. Oh my God. Z is Cuban. Haitian. Nah. El Salvador. General Zod. Z is from his mother. Rest in peace to my mom. I'm sure she would appreciate that answer. Rest in peace to my mom. It's actually 2 days ago was the anniversary of her passing. So yeah, I'm sure she would appreciate that. This was really fun, guys. I this was probably the littest live that we've ever done in terms of likes, 1,600 likes, in terms of comments, in terms of the questions, in terms of the commentary, in terms of your donations to St. Jude. This is definitely the littest live that we've ever had, and I appreciate you guys for this. It's been really fun. But yeah, watch out for the socials for new membership info coming out. I'm gonna take my happy ass to Chipotle. Thank you, Shafiq, for depressing me and telling me that that they will likely be out of the chicken al pastor. Hopefully they're not. I'm gonna go. I will report back to you. I will text you and let you know what's up. But yeah, Z is a lion. Z is from Staten Island. So he's from Shaolin. Dolly, thank you so much for your donation. Wish I could afford your program. Love your sense of humor. Hey, Byron, you know, I did say that if you guys hit 1,500 likes, I will release a monthly, you know, a more streamlined version, a more stripped down, bare bones version of the Discord. So you might be able to afford it soon. Puerto Rican from New York. Mauritian. Wow, Mexican. Tell us. No, I'm definitely not going to tell you because I really enjoy you guessing, and I actually love the fact that I can relate to each and every one of you. For sure. Bing bong. All right, guys. Appreciate you guys. I will catch you on the next live. Thank you so much for joining. Thank you for your donations. Thank you for making this fun as always. For those of you in the academy, I will catch you in there. Half an hour left until market closes. I'm going to go get some food, and I will see you guys on the next one. Peace.